My friends, we're sitting in an economic crisis. And the problem is, I don't think many of us really understand the simple basics of economics. And I'm starting a series of videos to explain the economic crisis. Because when you get to, especially an economist, he can talk for 2 minutes and say nothing. Why? It's big words. It's complex ideas and stuff. We have to break this down. This is simple, my friends. And so let's get simple. Do we know what the stock market is? I'm going to start with the stock market. Got a book here, Moral Guidance by Healy. I'm not going to bother looking it up. He says we should put no more money in the stock market than we would go to Vegas and put on the crap table. He compares the stock market to gambling. Why? Well, many of us have placed our future into stocks. So why does Healy compare it to gambling? Because of the speculation. But we have to go back, what's a stock? And then we can move maybe forward into how the speculation changes a prudent investment into a bad bet. A stock is very simple to understand. If I buy a share of IBM stock, I am buying a piece of IBM. Let's say there are 1 million shares. I buy one, I own 1/1,000,000th of that company. It's like going out and buying one share in the local grocery store which has 100 shares of stock. I own 1% of that grocery store. I participate in the profits and losses of that grocery store. Okay? If that grocery store becomes more valuable, logically my stock should increase in value. If the grocery store should burn down, value of my stock should burn down. It's simple. I'm buying a piece of a company. It's everything from the local grocery store to IBM to Microsoft, and anything in between. I am buying a piece of a company. And the investment is either good or bad based upon whether that particular company is good or bad, or a good-bad investment. Good management, bad management. Okay? Won't go into all the details. Buying a share of stock is something we should do with prudent thought. Okay? Like we would do with investing money, buying a new house, buying a car, buying a new refrigerator. Any of our major decisions, buying a share of stock is a major decision, and if we decide to buy 10 or 100, we're going to put a $50 in or $1,000 in. That's how we should evaluate it. Okay, so buying stocks is either a good or bad idea, depending on whether that stock's good or bad. And it's a judgment. Is it a good idea to buy it today? Okay, so stocks are simple to understand. That's where we got into speculation back in the late 20s. Now, if I just pay cash, and if everybody paid cash, that reduces the risk of the investment. When you reduce the risk, you also reduce the potential reward. We all want big rewards. There isn't anyone sitting here watching this right now who would mind winning the lottery tomorrow, or receiving a letter in the mail with a check for $1 million. I'd like it, you'd like it. No problem. So we go out there, and when we invest, we want to increase the potential that we could get that $1 million. That's when margin was invented, in the 20s. It might have existed before, but that's when it was really ramped up. Okay. Instead of taking $100 and buying a share of stock, I take $100, I borrow another $900 and buy 1,000 shares of stock. or 10 shares, I think, in this example. Okay, I buy 10 times as much stock as I could before. All right. Just the mere fact, as the margin was permitted to be bigger. In other words, at first, the margin was simple. You had to put down 50%, and you could borrow the other 50%. So if you put up $100, you could buy $200 worth of stock. Then they reduced it to 40, to 30, to 20, to 10. Now, if a lot of people run out there, and I bought $200, let's say 200 shares of stock, and I paid $200 for it. I borrowed 100, and I put up 100. Now, a couple years later, a guy can run out $100 and he can buy 1,000 shares of stock, or $1,000 worth of stock. We're increasing the demand. In economics, there is a simple principle of supply and demand. If the demand for an object increases and the supply remains the same, the price increases because you've got more people wanting this, so they will pay more to get it because they're fighting with each other. It's like an auction. Okay. Maybe we could compare it to eBay. Okay. More people running in, the price goes up. Well, the guy who put up the $200 may have seen his price go to $300, $400, $500. Well, the dumb fool didn't take his money, when he saw his $200 investment, which he borrowed $100, go to $500. He could have sold out, paid the $100 off, and put $400 in his back pocket. He could have made 4 times his money. But we tend to be greedy. There's a saying in the stock market: bulls make money, bears make money, hogs don't. In other words, those who they see their increase, they move out and take their profit and run and look for another opportunity. But margin is what made the late 20s stock market, boom, go right straight through the roof. Another thing, what goes up must come down. That's why Healy compared it to gambling, because he'd just seen it. He wasn't too far past it. And we saw people lose everything, including their life, going out the window. So that's what brings in the risk, because people want a bigger reward. Benedicta potentis, Patris et Filii, Spiritus Sancti, Sen Super Semper. Amen.